Up, we have Agostino Capponi from Columbia University, and Agostino is going to tell us all about non-native tokens and price discovery. So,
okay. Thank you, Seb. Thanks for coming back on time after the break. And yeah, important. And thanks also to all my co-organizers of this workshop, like Sebastian, Faisal. And the idea is basically to discuss, this is very much ongoing work. Unfortunately, I couldn't present the work that Faisal presented and one that Johannes presented, so I had to present this work, which is still work in progress. But hopefully that's, I mean, the point is actually to get some feedback from you. For now, it's mostly, it's very empirical, and we have an idea that we want to develop. So I very much welcome your comments. I joined to work with Konstantin Sokolov and Zhang Zhang, both study in Canada, so there is some connection to Canada. So let me see. Okay, no, I think I'm going the other direction. Yeah, sorry. Okay, good. So let's first discuss what is the main objective of this work, is to understand whether or not having more adoption, or if you have more usage of the blockchain, is it always good? Or maybe there are some unintended consequences that we are not thinking about. And this is the objective of this study, to understand what are the implications of trading non-native tokens, and I will discuss what a non-native token is, on a blockchain. How does it impact the price discovery process on the underlying blockchain? So the first step is to, I mean, this has already come up in other talks. I think Faisal explained the role of priority fees, but I'm going to repeat just because I want to make sure that we are on the same page. So if we think about a blockchain, we have a lot of users who are competing to execute transactions. So they send their transactions to the memory pool of a blockchain. Every transaction has a fee which is attached to it. For example, this user 4 is willing to bid a fee of $4. So if that's the case, then when the validators, who are ultimately those who are in charge of constructing these blocks, will have to pick the transactions, will pick the transaction which is bidding larger fee, because they get to keep the fees. So their source of revenue are exactly the fees. So if you want to gain priority, you should bid the larger fee, right? And the block space is limited. So if you have only 4 slots, in this case, all 4 transactions will be included. But if you have 3 slots, maybe the transaction 1 would be excluded because they are not bidding enough fee, and therefore they have to wait to the next block in order to get executed, right? So that's the idea. There is this priority fee mechanism, which is important. And the question is, okay, price discovery, how does price discovery relate to the adoption of blockchain? So if we think about price discovery in the native cryptocurrency, so native means, let's say we have Bitcoin, the native token or the native cryptocurrency of the Bitcoin blockchain is Bitcoin, right? If you think about Ethereum, the native cryptocurrency of the Ethereum blockchain is ETH. And of course, you want to price discovery in this native cryptocurrency is very important because it ensures somewhat that the blockchain is stable, right? Stable in the sense that it's not subject to attacks, because if the cryptocurrency is strong, it has a large value, so it's difficult for an attack to borrow it. And if you want to make an attack on a blockchain, what you can do is to borrow the native token, then be willing to pay a large fee in the native token, and therefore execute the attack. So if we have like strong cryptocurrency in terms of value, then it will be more difficult to execute these attacks. So if we have wide adoption, so if everybody wants to use Ethereum because they launched the smart contracts, then everybody will be basically willing to trade it, which is the native cryptocurrency of the blockchain, right? So the native cryptocurrency will go up. It's like as if everybody wants to buy iPhone, then the price of the Apple stock will go up, right? Similar is for Ethereum. If everybody wants to adopt or trade on Ethereum because it offers so many different services, including, let's say, decentralized exchange, lending and borrowing, then the price of this native cryptocurrency, which is it, will go up. So that means that there will be a stronger network. So it will be more secure. And many papers have highlighted this importance, like, I mean, the fact that it facilitates consensus among validators, it is less subject to manipulation, and so on, right? But the point is that we want to highlight here is that if you over-adopt blockchain, which means that if there is too much traffic on a specific network, especially if this traffic is involving non-native transactions. So transactions basically which involve tokens which are not the native currency of the underlying blockchain. For example, if I want to use Ethereum and I'm using wrapped Bitcoin, so I'm using a token which is native of another blockchain to trade on Ethereum. That's a non-native cryptocurrency. right? And this might actually affect price discovery over time. So it might actually make the native token cryptocurrency weaker. So that's what we are saying, that if you create a lot of congestion on the network due to usage of a non-native crypto token, then this is a problem. Yeah, Faisal.
Obviously, non-native transactions have always been. I mean, you can imagine that non-native transaction may have positive utility flows in terms of native tokens later on when you have transactions that involve non-native versus.
Yes, that's a good point. So in principle, you might say if you use non-native transactions, maybe there are some positive externalities on the native transaction as well. Here we are basically arguing that we are only looking at, first of all, we don't have a model yet to analyze this trade-off. And I think the second is mostly we are looking at whether or not empirically you observe that things are getting worse. So it's mostly empirics. We don't have the trade-off yet. So it's possible that what you're saying is also right. The question is which effect dominates. Is it more that you have some positive effects on the native cryptocurrency if you are, let's say, using the underlying blockchain to host non-native cryptocurrency, or is the effect that you create too much congestion and therefore you harm the price of the native cryptocurrency? So that's a good question. Yeah. Thanks for asking. Good. And essentially, we are saying, okay, this might happen. And now the question is, how do we demonstrate it? And I want to make an analogy with what happens in traditional markets. No, I think an analogy which seems to be somewhat relevant is like gambling. If you think about traditional markets, you would like essentially to trade only with the purpose of fundamental. Like if you see that there is some fundamental, if you see that there is a value because you believe that a company will grow due to its expansion and activities, then you want to buy that stock, right? You would like to trades to be driven by fundamental value, but there is also a substantial share of trades which are just gambling, right? You are just buying because of social effects or social media tell you to buy the stock, but there is no real underlying value in buying. You don't know if this is really driven by changing fundamentals. And there have been a few papers that have highlighted that if there is too much gambling, then prices become inefficient. So they deviate more and more from fundamental, and then you can have bubbles and many phenomena of this sort. So for example, like in secondary, if you have a secondary market, even if you have a derivative market, the derivative market might be used to bet or to take bets on the value of the primary security. And of course, if you don't use it properly, you might end up overinflating the price of the security, but not because there is fundamental value, just because you keep buying these options. So I mean, it's somewhat related, but here we want to see more like how these non-native transactions are affecting the price discovery of it, which is the native cryptocurrency of Ethereum, right? We are looking at Ethereum because it's the largest blockchain in terms of transactions. They have smart contracts, and we want to ask this question: do non-native transactions harm the price discovery of it? Right? If you have too much like non-native transaction, what happens? And Ethereum blockchain is basically well known because it's a platform where you can transfer non-ETH value, meaning you can transact a lot of non-native Ethereum tokens. For example, non-fungible token is an example. So these are NFTs, and I will describe more what they are. They're essentially digital representation of objects. It could be art, it could be music, it could be art. These are non-native, right? They have nothing to do with the native cryptocurrency of Ethereum, but nevertheless, they can be transacted on Ethereum. You could also have the so-called ERC20 tokens, which are essentially ERC20 is basically a smart contract protocol which constructs decentralized cryptocurrency which can be traded on Ethereum, right? These are like non-native cryptocurrency as well. There are the so-called wrapped cryptocurrency. For example, if you want to trade Bitcoin on Ethereum, you cannot trade the native Bitcoin. You have to wrap it around the Ethereum protocol, and this is called wrapped Bitcoin or wrapped, I don't know, Poly, which is the cryptocurrency of Polygon. So you have, these of course are non-native transactions which are being traded on a different platform. And then there are all these Ethereum-based governance structure. For example, if you launch a new project on Ethereum, Uniswap, decentralized exchange, typically these companies are issuing these so-called governance tokens, which give you the right to vote for decisions. So for example, if you want to make a change to the Uniswap protocol, you want to go from V2 to V3, then you need to get this approval, right? So there is a board, and in order to vote, you must hold these governance tokens, which are again non-native tokens on the Ethereum blockchain. So these non-native transactions, the bottom line is that they're occupying space and they may increase the transaction cost, right? Because if you have a lot of non-native transactions that are traded on the blockchain, then this will lead to increasing congestion costs. So there will be a lot of traffic over the network, which is caused by non-native tokens. Okay, so now what happens if congestion costs go up? It means that the native cryptocurrency, in this case, the native Ethereum cryptocurrency, price discovery might actually become lower, right? They might deteriorate. The reason is that if the native token becomes undervalued, because if there are few transactions involving this native token, because they cannot get on chain due to the fact that other non-native transactions are taking the priority, maybe the higher fee, they have a larger urgency to trade, then the cost of borrowed coins goes down because it's easier to borrow native transactions, the price is lower. Therefore, it's easier to make an attack, because to make an attack on the Ethereum blockchain, you must hold the native Ethereum token. So if it's cheaper to borrow because the price is going down, the stability or the security of this blockchain is impaired, and therefore maybe nobody wants to use it. So there is a risk that the price will even go to zero, right? And also, if the price discovery is limited, this says that it takes a lot of time for information to be incorporated into the prices because trades are slow. Then it's possible that you could dispose of the holdings. If I make an attack on Ethereum, I can then dispose of this Ethereum token before actually the information about the attack is incorporated into the prices, right? So you make the attack, and then before the token reflects the fact that there has been an attack, you dispose, and the information is not incorporated into the price. Yeah.
When I mean, you're making the link between high value of the native crypto,
right,
and this economic security.
Yeah.
You're allowed to make it back.
Yeah.
You're thinking of staking there, or
yeah, staking is one application, for example, because if you want to be a staker, a validator, then you have to stake your token, and if it's cheaper to borrow this token, you can stake more because I can put more tokens. That's a good example. Yeah. Thanks. That's it. So now, how do we test this empirically? We are relying on NFT airdrops. So what is an NFT airdrops? So we're not using NFT because it's trendy and catchy, but because it's a very good instrument. So NFT is essentially digital representation of art or objects and so on. And airdrops means that you distribute this token for free. So why would you do that? Because you want to incentivize users to adopt the platform. For example, when Uniswap first launched this exchange, they had an airdrop, or they wanted to build a community. If you want to build a community, you want many users to become part of this community, to participate in the trading and in the voting decision, and distribute this governance token for free so that users get involved and get interested into the project. So it's like building a community. How do you build a community? You have to provide some incentive for users to use the platform, right? It's easy to jump on a platform when it's already well developed, but if you are starting a project now and you want to build a community, so you want to solve these cold start problems, then you need to distribute them for free, and therefore you do an airdrop. So you drop some of these tokens from the air. And of course, you build a community, and you can also diversify some regulatory risk, because I mean, the alternative would have been to have an ICO or like a charge for this token, but then you bump into the problem that there must be some regulatory things that you need to take into account, right? Because if you have an IPO, then you have to do it properly, and if you are on a blockchain, the regulation is a little bit dark, so it's easier to just distribute this token for free. And that's the reason why we look at NFT airdrops, because essentially one of the ideas is that they are really, this is the most funny slide, it's really linked to social timing, right? So the reason why these are good is because if you want to see basically what's the impact of non-native transactions on the price discovery of the native transaction, and you want that these non-native transactions are not really linked to any economic activity. You want this to be linked totally to non-economic activities, such as social events. Right? For example, NFT, they are not really driven by any economic activity. No? They are just creating congestion because of social effects. And I mean, you see, like, for example, like the NFT on the former Pope, and the new Pope has just been elected, by the way. It's Leon 14. Yeah. So this is the old Pope. So they created an NFT linked to the old Pope, and this was like a Taiwanese, I mean, not Taiwanese, it was a Thailand-based Catholic church which minted this token, and the reason was to incentivize the local community to be more involved with religion, faith, participate in the events, and so on. So many users, especially younger users, use the technology. So if you create this NFT, you basically, again, build a community. Other NFT are like the hockey player Alex Ovechkin, who scored, I think, 839 goals, and then they created an NFT to celebrate him, again, to incentivize interest in the platform. Okay, but just the point of this slide is just to mention that NFT are basically linked to social demand, just social events. And I mean, again, if I go back to gambling, I mean, similar to NFT drop, if we look at transactions which have the only purpose is to gamble, are also guided by social events. Think about, for example, like GameStop, right? The GameStop, there is a paper by Lasse Pedersen which has analyzed precisely what drove this overvaluation of GameStop. What happened is that, again, some investors took a very strong stand that no matter what, they would buy the stock, right? And they were really committed to hold the stock. And then there have been a lot of Twitter messages, Reddit, and so on, many social media, which amplified this effect by saying that there was really an intention to hold these stocks for more and more. Then Elon Musk, social influencer, right? Much more nowadays. But he also tweeted like in terms of GameStop, and then the price overshoot it, and that's the reason why we had like an overvaluation, right? The GameStop went up a lot, and everything was driven by gambling or social events. There was no real fundamental change, right? The company was not doing anything special. But I think we can analyze this effect of social timing on the price of cryptocurrency using blockchain data, because we can really pinpoint the transactions that are conducted exclusively for reasons that have nothing to do with investment. For example, NFT have nothing to do with investment. It's not that you are really looking at why the price is going up because you are making investment or you are doing something which is financially relevant. No, this is really just creating congestion due to social demand and social activity. So that's why we chose to look at this airdrop of NFT to see how much traffic was increasing. Yeah, Kadia? Yeah.
I understand your parallel to gambling, but it's
Yeah.
different because gambling, you're right, there's gambling and then there's the security, which is driven by the firm value.
Yeah.
But I guess the question is, what's the value of ETH? Like, what's your stand on that? Because in a sense, I'm thinking when like the demand for it goes up.
Yeah.
I'm not thinking of it as a security because
Yeah.
like, when the demand goes up, the value of it should be higher. So how do you separate? But at least that's what I would kind of, I'm thinking demand went up, so the value should go up.
Right.
When it went down, the value goes down. So in a sense, to me, it's like this is affecting the volatility a lot of the native currency, but I'm not sure if it's like if you find it goes up and down, if it's price discovery or how do you separate the two, I guess.
Okay, that's a good question. So you're saying I still think that there is value in it, even if it's not cryptocurrency, just because if people want to use it, the value doesn't have to be driven necessarily by fundamental, right? The value could be driven just by the fact that I want to use it because it's useful. If it's a platform which carries value, then I want to hold it, even if I don't have a debt and equity structure for the firm.
So I think this is my question. If I want to use it,
Yeah.
does it increase its value? What's the fundamental? To me, like the demand for it is part of the fundamental for ETH, whereas it's not part of the fundamental for Apple if I want to gamble.
Right.
So that's kind of what I was trying to do.
So your question is, what does it mean, price discovery in this context, right? Yeah, it's basically, the short answer is that price discovery, I will link it to the price impact. So how much, like the classical notion of like aggregate price impact, if prices are actually moving, trades are moving the price, that means that there is price discovery. Maybe I shouldn't use price discovery, I should use different word, but that's what I mean by price discovery. The classical like Hasbrook 1991 and 1995. Does it? Okay, I would say. Yeah.
Alex Lipton said something that has no value may have any price. So
Yeah, exactly. So we have, yeah, right, yeah, exactly. Yeah, we can enter into the debate of what it means to price a crypto, but let's continue and then we can see. Okay, so there's the hypothesis. Maybe that's so the hypothesis is that If you have a higher number of airdrops or a larger number of non-native transactions driven purely by social activity, this is going to increase the number of transactions, right? If you increase the number of transactions, you will have to pay higher fees to get executed, so higher congestion, and this will imply lower informedness on trades, so the trades will be carrying less information, and this will reduce price efficiency. And I will define all this question, what I mean by trade informedness and price efficiency. So this is, I think, what we find is that if you have a shock to the NFT airdrops, then this leads to an increase in the congestion. So you have more transactions, larger gas fees that are paid, a larger transaction fail rate. So there will be a larger rate of transactions which fail. So especially if you see a one standard deviation positive shock to the number of NFT airdrops. So if you increase the number of NFT by one standard deviation, then the total number of transactions is increasing by 3.2 or 2.4% per block. So there is like a significant effect, like in terms of how change in the NFT airdrops impacting the total traffic, right? At least total number of transactions. We have similar results for the gas fee and transaction fail rate. Then we also see that there is a decrease in the native ETH cryptocurrency trades over a long horizon. If you look at 3+ hours to 5 days, so if you look at the longer term pricing, but not very short term, so 3 hours or more, or 5 days, you see that one standard deviation positive shock to the number of NFT drop is reducing the 2-day price impact. You look at the price impact over a period of 2 days by 4 basis points, which again is back to the question of Kadia, my understanding of price discovery, the fact that the price impact is being reduced. Like if price impact is lower, it means that presumably there is less price discovery. And also the efficiency of the price goes down if you look at, again, one standard deviation shock to the number of NFT drop is reducing the price efficiency by 0.9%. I will measure the price efficiency using the standard variance ratio measured in market microstructure. Okay. Question? Oh, okay, good. Okay, so let me describe how we collect the data. So we collect all the NFT drop data from the Ethereum blockchain, and this can be done by calling a C-drop function in the smart contract. This basically this C-drop function is basically the function that is used to deploy the to do the Sorry?
I did have a question. I just took time to formulate it.
Okay. Your questions are always hard.
Reduce price efficiency
Yeah.
of price discovery.
Yeah.
So true in a sense, but when I'm thinking of traditional market microstructure,
Yeah.
it's just noise trading.
Mm-hmm.
I'd expect it to like. I'm not sure if it's necessarily like the price impact and price efficiency price discovery is exactly synonymous, because if you just have trading for noise reasons, for non-fundamental reasons, so to say, like they have temporarily increased it.
Right.
But then it goes back to normal, and so that like we can
But then
noise.
that's
So
true.
we shouldn't expect a large price impact because it was noise kind of.
Right, but suppose that I show you that the price impact over like a few days is large, then it's not really, if it's noise trading, then it would be mostly temporary, right? That the price will revert back to its value. But if it's like due to information, then you expect that the price impact over like a period of 5 days or more will be there, right? It's not really zero. So if I take the difference between the price 5 days from now and today, and I see that it's positive, I think this is somewhat evidence that there is some price discovery. And I think that's what I want to illustrate. So I agree. In fact, I think you will see that depending on the horizon, you will see different results. Good. So we use this C-drop smart function in smart contract, which is, again, as I mentioned, it used to deploy this NFT in any EVM compatible blockchain, so any blockchain which is compatible with the Ethereum virtual machine. And then we do a so-called diff in diff analysis with Polygon blockchain data. So the idea of doing this difference in difference is basically we want to choose this Polygon blockchain data as an instrument. And the reason is that Polygon is also another blockchain where you can deploy NFT, but it is much less sensitive to congestion, because it has basically a very much faster transaction speed, in the sense that it constructs block much more frequently. and you have a smaller average gas fee to go on the Polygon blockchain. So we want to basically choose Polygon blockchain as an instrument so that when we look at the difference between Ethereum and Polygon, if we see that there is, let's say, a positive increase in the number of transactions, or in terms of the reduction of the price impact, by looking at the difference between the price impact on Polygon and Ethereum, or the number of transactions on Polygon and Ethereum, this must be really due to the congestion, right? Because Polygon is not very susceptible, is not very sensitive to congestion, right? That's the idea. Yeah. Yeah.
The link between price impact and efficiency.
Yeah.
This is Uniswap transaction data, so it's an ANN number, right?
Yeah. I will use Uniswap transactions to compute price discovery. Yeah.
Three factors in the contract.
Yeah.
It's not the classic microstructure based on the reaction of market makers.
Yeah. No, the price impact is just looking at the price impact is basically looking at the difference in prices before and after.
Yeah, compared to say one classic microstructure. So that link to price efficiency and price discovery are not as clear to me in the context of a AMM, where the impact is determined by the
yeah. So I mean, for me, the price impact is basically the difference in prices. I mean, if I see that there is a positive, if the price is changing, then it means that the trade has caused an impact on the price. I think it's independent of whether it's on Binance or it's on Uniswap, right? If the price changed, that means that there is a price impact. Sorry? Permanent, yeah. Yeah, if the difference over a long period is non-zero, then I take this as an evidence of price impact. Yeah, that's the standard, like Hasbrook 1991. Yeah. So we look at Uniswap transaction. The Polygon is again the blockchain that I'm using as to do this different analysis. Then we look at Uniswap transaction data, because these are the ones that I use to basically measure the price impact. These are swaps that you do on Uniswap. And then we look at builder day panel data. So as probably some of you already know, the Ethereum has gone into this new separation of responsibility blockchain, where builders are building the blocks, and when the builder get to build the blocks, they have full monopoly of which transactions we include into the blocks. And we are basically looking at the data every day. We look at the builders, and we look at all transactions that have been included by the builders in those blocks. So the panel, basically based entities, are builders, and the time is the days. And we look at 50 builders who build 90% of all blocks in Ethereum and 97% of all the block in Polygon. So we're capturing pretty much most of the builders, and we pair them because we want to do this diff-in-diff estimation. So we look at the difference between the top Ethereum validator with the top Polygon miner. So we match like the top builders, which means those who are building most of the blocks, and then we look at the difference between them in this regression. So at the end, we will run many regressions. So this is just an example on an FTR drop. I mean, you can see really the code, everything is very transparent. This is basically an FTR drop. You see when the transaction happened. This was 69 days ago. So, and you see what's the function that is being used. But yeah, again, this is that's all information that is available. And if you look at also, these are some descriptive statistics of the data. We look at the number of airdrop transactions. You see that there is sometimes serious variation. So there are like transactions somewhat over the different months. And we also can see that Ethereum and Polygon follow a very similar trend. They are very positively correlated, right? So that means that using Polygon to control for congestion effects caused by Ethereum only is probably a good choice, because the transaction flow is very correlated, right? When the number of transactions is going up on Ethereum, it's also going up on Polygon. I mean, we could compute the correlation, but should be very high just based on looking at this graph. Of course, the number of transactions on Polygon is larger than the number of transactions in Ethereum, because again, Polygon has a much larger capacity. Like the transaction speed is faster, and so it produces many more transactions. In fact, it was created exactly with this idea of being more scalable, and this is what you see reflected in this data. And these are summary statistics of the data. these are the summary statistics computed at the level of builder and day. So builder day panel for each, like, let's say we look at the mean and the median. So this is the mean, the average number of transactions per day by a builder. And you see that the statistics are larger for Ethereum rather than Polygon, because even though Polygon has a larger transaction speed than Ethereum, nevertheless, there are more transactions per block which are included on Ethereum compared to Polygon. Larger number of airdrop transactions, larger number of airdrop transactions, larger number of transactions overall, a larger fee that is paid on Ethereum, right? Because again, Ethereum has like block time every 12 seconds, whereas Polygon is much faster. So now I think it's mostly describing the results. So we look at, let's say, run the regression. So these are different regressions, like the delta number of transactions. This is the difference between the number of transactions added by the builder I in day T in Ethereum minus the number of transactions added by the builder that is meshed with builder I on Polygon in day T. So if this difference is positive, it means that there are more transactions added by the largest builder on Ethereum compared to the larger builder on Polygon. For example, if I is equal to 1. And you see a delta NFT airdrop is the difference between the number of airdrops done, number of airdrops picked by builder I in Ethereum minus the number of airdrops picked by the corresponding builder on Polygon. So because we want again to control. So in a way, if you have what you see in this graph, in these regressions, is that the coefficients in the change in the NFT airdrop is always positive, which essentially means that if you have a larger number of NFT airdrop on Ethereum relative to Polygon, this is causing a larger number of transactions in Ethereum relative to Polygon. So it's increasing the number of transactions, right? And this is, I think, again, controlling for the fact that congestion is lower. It's larger in Ethereum, but lower in Polygon. So this must be due primarily to congestion, right? Because we are also taking the difference with respect to Polygon. And the results, like you see that they are also, I mean, we also added some control variables like Ethereum volatility, Ethereum volume, because you might ask, okay, why isn't, maybe this is just due to the volatility of Ethereum, or this is just due to the volume that you're trading. But even if you control for volatility and volume of Ethereum, the result remains statistically significant and economically significant. So it's not really driven by the volatility, right? It's driven primarily by this demand for social activity, which is caused by the NFT. And it means you can also do a calculation in terms of standard deviation. So if you have one standard deviation increase in the number of NFT drops, which means of, again, Ethereum relative to Polygon, this is increasing the total number of transactions by 2.4%. So it's not. So then we look at the average, again, I want to go to the price efficiency and price score, but I first want to measure like the congestion, and we calculate the fee per gas for each block, and we take this ratio, the total fee divided by the total gas. So the total fee is the total at, which is the native cryptocurrency of Ethereum, that users are paying in transaction fee over a time period. In our case, it would be a day. So what's the total fees that is being paid to the builder over a day, and we divide this by the total gas, which is units, which is the total units of gas consumed to execute this transaction. So in Ethereum, in any blockchain, there is this notion of gas, and the reason is that every transaction requires computational power to be executed, and the gas is the unit of measure of the code that you need to, or the CPU cycles that you need to execute in order to execute this transaction. So if you take the ratio, you are essentially looking at the effective price, right? The average gas, the average fee that is paid to execute these transactions, right? It's the ratio between fee and gas, total fee and total gas. And then we run the similar regression. Now here, as before, we look at what is the delta in transaction cost. In this case, the transaction costs are measured in terms of this average fee. And we regress it against the change in the airdrops, controlling again for volatility and volume. And you see again that if you have an increase in the number of airdrops of Ethereum relative to Polygon, this will increase the transaction cost measured in terms of total fee divided by total gas. So again, congestion is going up on Ethereum relative to Polygon, right? Even if you control, again, it's not driven by volatility or volume, because if you control for them, which is the last regression, you see that the coefficient, of course, decreases. It's like 1.312 instead of 5.133, because some of it is captured, of course, is being picked by the volatility, but there is still a significant coefficient and positive coefficient. So that's the other result. So then we say, okay, let's look at another measure of let's say, inefficiency is the fail rate, which is, again, related to the question of congestion. So the fail rate per block is defined as the number of failed transactions divided by the total number of transactions. So what does it mean that the transaction fails? A transaction can fail for several reasons. First, you run out of gas, right? It's like you are driving a car, you have to go, let's say, from Toronto to Montreal, and then you don't put enough gas. So you have a limit on the gas that you want to use, and you run out of gas. That means the transaction can fail. That's one of the main reasons for transactions to fail, that they don't have enough gas, because their gas limit has been exceeded, and the transaction is not executed. There could be some input errors in the smart contract. Maybe you call, this is like some operational risk. And then there could be that you exceed the slippage threshold. When you want to execute a trade, you say, okay, I want to swap this Ethereum for Bitcoin only if the price leakage is lower than, let's say, 20% of the current value of the price. So if the price leakage is too large, for example, if somebody is executing a very large order and for is driving the price too much, then you basically say, okay, I'm not going to execute my trade because the slippage threshold has been exceeded. In this case, the transaction would fail. So that's the third reason. And we look at the ratio between this number of failed transactions divided by the total number of transactions. And then we do, again, similar regression. Now we regress the change in the NFT drops, the change in the fail rate of Ethereum versus Polygon on the change in the NFT drop. And you see again that the coefficient is positive. So that means that, again, if there is an increase in the number of NFT drops on Ethereum relative to Polygon, this is going to increase the failure rate of transactions. So there will be a larger failure rate on Ethereum versus Polygon, right? Because this coefficient is positive. Again, it remains positive even if you control for volatility of the Ethereum price, of it and volume, and similarly, if you control for this dummy variable, which are called fixed effects, so builder fixed effects or day fixed effects, the results remain the same. In fact, in this case, you see that the coefficient remains really very similar, on the order of 6. Okay, so now let me measure the price impact, which is, again, my measure of trade informedness. So the price, I look at the price impact of tokens of transaction on the axis. This transaction that I consider or execute on the decentralized exchange are swapping the native Ethereum token or the native Polygon token, which is called Matic. Matic is basically the native token of the Polygon blockchain. And then I look at the price impact as the measure of informedness, right? I look at the difference between the log price at time t minus log price time 0. So this is the token price after time t. So you want to see if it's really what Kadia was saying, maybe just a measure of noise trader. So in this case, you would have 0 permanent price impact. You just have temporary price impact. Or maybe there is an effect that remains in the price, which means that there must have been some information that has been incorporated before there must be some price discovery. And then, of course, D will be equal to 1 or 0, depending on whether you are trading in or trading out the token. So if you are increasing or decreasing. And this is basically how the graph looks like. You see that, if you look at the interval of 5 hours, 10 hours, this could be due perhaps to just noise trading. But if you look at a larger period, up to 5 days, we see, and then now here we want to see what happens in terms of the percentage, the delta of the price impact versus the delta in the NFT drop. So if you are increasing the number of airdrops on Ethereum relative to Polygon, right, then you also expect that price discovery in the native cryptocurrency will be lower. So that means that you expect the delta price impact will be lower. And this is what you see in these regressions, right? You see that the coefficient is negative. So this hypothesis that there is less price discovery proxied by this change, proxied by this price impact measure, which is just the difference in prices, it's really reflected in these regressions, right? You see that over the period of 5 days, the coefficient is always negative. Over a smaller period, let's say 5 hours, 10 hours, it could be positive, because maybe there is an overshoot in the price. But then if you look at the longer period, which is 5 days, you see that it's negative. In fact, if you have a one standard deviation positive shocks to the number of NFTR drops, then this is reducing the 2-day price impact by 4 basis points, which is something, right? It's not really negligible. Yeah. So finally, we look at variance ratio to measure the price efficiency. So this is basically, we look at, for each token per day, we compute 2 measures of price efficiency. So the variance ratio is essentially computed using the variance of intraday returns over different intervals. So sigma squared k times L is the variance over the longer interval. So if k is equal to 15 and L is equal to, k times L could be 300 seconds, let's say, and L instead is just 15. Right, so it means that k, in this case, k would be equal to 20. So I look at the variance of these intraday returns over 20 different periods of 15 seconds divided by the variance over a period of 20 seconds multiplied by 15. So if prices are efficient, then you should have the sigma squared k times L should be equal to sigma squared L times k. So the ratio should be equal to 1. For efficient prices, the ratio should be 1, right? So the variance over a longer period should be equal to the variance over the shorter period times the number of periods to go from the shorter to the longer period. If you see that this variance ratio is, if this ratio is far from 1, it means that there is some inefficiency price. So that's really the argument that is used when people measure the price efficiency. So let's look at what happens. Now we run this regression. We look at the return of the token pair, again, on Uniswap, during the interval L, and we regress it against the return of the S&P 500 proxied by the SPY ETF. And then we look at the R square from the above regression with and without the lag market return. And this is basically, again, the other measure of price efficiency we're measuring is the price delay. We want to see how fast prices are reacting, right? If there is a larger price delay, it means that information is incorporated more slowly into the prices. And this regression will tell us exactly the speed at which information gets incorporated into prices. And then we look at this regression, again, variance ratio and price delay. Again, you see now that these are not really different regression. This is really just Ethereum, right? We're not comparing Ethereum versus Polygon because, yes, these are basically obtained by looking at prices of these tokens on Binance, and there is no Binance on Polygon. Right? And you see that, again, the results are in a way as you expect, because if you have a larger number, if you have an increasing number of NFT drop, this is increasing the variance ratio. So there is a positive coefficient, so more non-native transactions is increasing the variance ratio, which means is making prices more inefficient. Yeah.
Sorry. So the measures, I guess it's also a question of how you interpret this. Variance ratio is supposed to be, it kind of measures how close you are to random walk. Like
Yeah.
It's supposed to be a random walk.
Right.
And if you have this airdrop, this is exactly where I think we expect it to be a deviation from a random walk, because I expect the price to actually go up because of the NFT airdrop. So I'm not sure if like the variance ratio is the best. Like it's sort of, this is what I'd expect, but I don't know if this is the price inefficiency, because this is also exactly the time when it shouldn't be random walk. It should just go up. I expect it to go up because of the NFT airdrop. So I'm not like that's kind of
right. No, I agree with this. Yeah, I agree that variance ratio is basically considered with random walk. Thanks for asking this question. But I'm thinking, would you say, but if you are deviating from the random walk, wouldn't this mean that the prices are more inefficient? Because I mean, for prices to be efficient, they should follow random walk, right? If you are deviating from the random walk, then it means that there is inefficiency, like according to the efficient market hypothesis. But
you're conditioned already on there being this NFT, like in a sense, I'm wondering if it's like I should not expect it to go up, but if I already know that this is coming, like or this is like is there anything that is backward looking that drives this?
Okay.
Because it's on a daily basis, so this is kind of what I have in mind. Like just
I see. So backward looking because you're saying I look at the airdrops over the day, right? And you're saying this might change. They might lead to a change in the price efficiency. Yeah, that's a good point. I have to think about that. I agree that there might be some backward-looking bias that is maybe driving the results. Yeah. Thank you. Yeah, and also in terms of price delay, you see that it takes somewhat longer for prices to react, because if you have an increasing number of NFT drops on Ethereum, so then you have that the price delay goes up by 1.484 seconds, right? So there is again, information is being incorporated slower into prices because of these FTR drops. And again, you see that price efficiency is reduced by 0.9% when you have a positive shock to the number of NFT drops. Okay, so I think it's pretty much on time. I mean, this again is work in progress, so any feedback is really welcome. Thanks for all the comments that you have made. And the main result was basically saying that because of this increasing congestion caused by non-native transactions, such as NFT airdrops, this is reducing price efficiency, is reducing trading formativeness. So in terms of market microstructure, it's somewhat reducing the market quality of these native cryptocurrencies, which, as I mentioned before, is valuable for blockchain stability. So that's something to just take into account. Thank you.